Hi there. Welcome to this seminar on mining flow-throughs as a plan giving tool. PearTree had sent out a questionnaire to users of these seminars saying, what do you want to hear? And some wanted to have this seminar, how mining flow-throughs can be used as, as a plan giving tool. Not enough to have a full-blown live seminar, but enough to have a mini seminar, and that's what we're going to do today. So let me just talk about my philosophy on plan giving. And so I find that in the environment, we tend to look at either mining flow-throughs or marketable securities or charter major trusts as products. Oh, we have products. Bequest, it's a product. I don't believe in that at all. They're not products. Plan giving, plan giving products. Plan giving, well, it's two words. Giving, okay, we got that, and planned. So to me, a planned gift is a gift that is planned. Okay? It doesn't mean that you took a product, bought a product. It may mean that you use a tool, okay, but it doesn't mean that if you get a product, it's a planned gift, and if you don't, it's not. It just means planning arises in order to make a gift. So I want this little seminarette to have that in our back of our mind, that we want to be part of a plan. We want to develop a plan, which often today mining flow-throughs can be part of that plan. And that's how we're going to look at this. Okay, so we're looking at this as tools. Okay. And obviously, mining flow-throughs are used to make gifts. It's simple. The obvious one is I want to make a gift to the hospital, to United Way, to university, whatever you're doing, and say, yeah, I want to make a gift of $36,000. And well, if I use this tool called mining flow-throughs to plan my gift, that's pretty good. Because if it works for you and you have the right tax return and it fits into your own situation, your own plan, and your cost of giving of the $36,000 means you're out of pocket, $1,200, $1,500. You're poor by $1,500 by making this $36,000 gift. Great, you've used a tool to make a gift, and that's fantastic. And thousands of Canadians are now doing that. Are now doing this, and increasing their philanthropy because perhaps their gift would have been $25,000, but now they're making it $36,000 because they're using this tool. Okay. But how do we get past this? Okay. So this is the next point. Is you're going to say, what are you talking about? Okay. So what is a private foundation or a donor advised fund? That's where people put in their sums of dollars charitably and use that to pay out their gifts. Okay, and so to me, the biggest plan giving tool that I've seen that mining flow-throughs have been around with is into the donor advised fund or private foundation. So if you wanted to make a university gift of $36,000 and you're going to go ahead and do a mining flow-through, and in actual fact, you could do comfortably a mining flow-through for $50,000, under the rules, regulations, under the limitations, and you can do $50,000 of donation. You put that into a donor advised fund or private foundation, and now you have $50,000 sitting there. And now when you want to make your gift to the university of $36,000, you make it from there. But you also have $14,000 left in the fund, and then you can make gifts of $500, $1,000, $200, $3,000 to many other institutions with those dollars. And just as the cost of the $36,000 gift at 4% or $1,500 is pretty good, that also makes your $300 gift to the food depository, the food kitchen. That cost of my gift is $150 or whatever. It makes all your gifts subject to this great tool. Okay, and we can think of this now. Now I know that fundraisers for the university, for example, have difficulty in saying, "Oh, let's set up a donor advised fund." But actually, when you're doing this, you help your advisor by saying, "Hey, why not do more than the 36,000 and do it that?" And you're helping them. And I'd like to see more Canadian charities, like universities and others, do their own sort of charitable foundation funds where they keep where their donors put in more money than their gift directly to the university, and the foundation will then pass out to others. So what a relationship tool. To me, planned giving is all about, it's a plan. The only way you do a plan is with relationship. And every charity, you read the book, How to Be the Best Fundraiser. It's about trust. It's about relationship, right? So relationship is furthered when you're taking in for your university $50,000 with a direct thing that says, great, and now you'll inform us where you want the $14,000 besides your $36,000 gift to go, and you'll call us, tell us when you want it to go, and we'll take care of it for you. Okay, that's furthering relationship. Also furthers trust. When you're dealing with that and you're getting in there and whatever, and they're taking care of you, and wow, thank you so much, they trust you more. So I put this on the top of the list. It's not the obvious, but I really like them in pushing for institutions to start their own donor advised funds. Donor advised funds are exploding in Canada, exploding like this type of thing, not 100-fold a year, but more and more and more are happening. More people are taking advantage of it, and mining flow throughs are part of the reason for the explosion, because people are doing them and saying, "Oh, why do it just for my one gift? Let me do it for my collection of gifts." I can't buy a mining flow through for a $500 gift, right? And you're not going to buy a $2,000, a $1,200 shares of a mining flow through to do a $500. You won't do that, but you can do it for $50,000, and therefore the smaller gifts get there. So that's my emotional point about this. Okay, the next one, insurance, and I've talked about this before in our seminars. So I've, a true to life example. We're dealing with someone who has done well, sold his business and did some stuff for a charity, and then he wants to create a long-term gift for an institution, call it a bequest. Okay, that will effectively be, he's a big annual giver. Okay, and says, when this happens, that bequest, that amount will continue to be able to make that big annual gift, right? So if someone's making let's say a $100,000 annual gift to a charity and says, I want to create a bequest of some kind that will put $2 million in your fund, and therefore from the $2 million, you can have a 5% payout, $100,000 go into the institution for use, every year, perpetually type of thing. Great thing. Charities should be pushing their people to do this, right? So that your good donors continue when they're no longer around, their children move away, and everything else like that. So in this example, we actually, this was a $4 million insurance policy, and and it required a number of payments over a period. Trying to remember, even if it's wrong, it doesn't make a difference. Let's say 5 years of payments of premiums paid to the insurance policy. And let's assume, and he was relatively young. I think he was low 50s type of thing. Let's assume that there was, I'm trying to think whether it was 800, let's assume there was $1 million of premiums. Okay. And so it said, okay, 5 years of $200,000 each, and that would set up this $4 million policy. Okay. So we looked at the mining flow-throughs then as a tool, okay, to say, you have to give $200,000 a year as a donation to the charity to pay the premiums. Charity owns the policy for 5 years. So let's look at your personal tax return, which is quite big, and see what we can do. Are you eligible? Do you have the scope? And yeah, you had 7-figure tax return. And consequently, we could buy sufficient mining flow through to achieve a $200,000 gift. Okay. And we did so. Okay. So years one's premiums were paid by mining flow through. That it is. And that was the plan for the 5 years. Now, things could change. There may be, for example, in 2024, are there AMT issues? More severe, there's always AMT issues with mining flow through. You can't buy everything. There's always a limit that AMT always. Now, perhaps with new rules coming in, we haven't seen final legislation on it yet. The limits on mining flow throughs may be a little harder, which just means you can buy less with the same tax return. Not good, but not the end of the world. It's still there, but not good. Okay, his plan would have been, you're in the fifth year, you won't be able to buy $200,000 worth of donation. Maybe it's only $120,000 worth of donation that can be done. Okay, well, how do we achieve the $80,000 other part? Let's work with that. That will be our next point that we're going to look at here today. So insurance policies, and here is a $4 million one. It doesn't have to be that size. It could be a program. If you're doing a program, we're trying to deal with bequests, which includes insurance policies as a way of getting bequests, and you have a program, then you should be showing examples out there to your donors of how some people have done it. Depending on their circumstances, that shows this person aged 62 bought a policy, a $200,000 policy. The premiums were, X dollars for so many years. They bought a mining flow through and paid it this way. Their annual cost of after the mining flow through of that premium for the year is so much times the 10 years of the premiums is so much. I think you build the platform by the putting the vision in people's minds of what people can do. Here's a 65-year-old, here's a policy, here's premiums, possibility, here's buying mining flow through, what happens. I think you have it as part of the presentation almost. And then, of course, it's up to them to look at their insurance. It's up to them to buy the mining flow through. You're not buying it for them. Make sure it's appropriate for them. You're not selling mining flow through. You're just educating people about their availability. You're not telling them how it fits into their particular financial situation. That's up to their financial professional to do so. You're just educating them on the possibilities. So I think insurance, and if I say insurance, like insurance has been a big topic in plan giving for years. It's hardly ever done. It's hardly ever done. And the insurance salesmen come in, we have this great product, everyone on your board, you're going to do it, things like that, and it withers out. That's my experience. And what I've learned, and with some great insurance plans, I'm not taking away from that, is that people, when they want to make gifts, they don't want to tie up their future finances in a certain way, in a convoluted way, with sometimes with convoluted insurance. Okay, with details and deductibility over many years. To make themselves wealthier. Yeah, they may do it, but I see the hesitation of doing it for charity. Here, this is a simpler mechanism than convoluted insurance. This is simple insurance paid out over a number of years, but having the mining flow through as making the cost of giving really minor. So instead of donating $200,000 and giving a receipt, and their after-tax cost of gift is $100,000 at death, type of thing. Here, you're creating the $200,000 at death. Your cost of premiums are $50,000, and the cost of donating mining flow-throughs, that $50,000 in your situation, maybe $5,000. Maybe less. So for $5,000, you're creating a $200,000 gift. I think you can show this, very nicely as part of a program to have it. Okay. So when we're talking about that other person, we said, okay, sometimes you have a program, and then you may have a problem. I can't buy mining flow throughs to that extent. So what I've done quite a bit is, when someone has a nice gift going in there, is we look at more than one tool to achieve the annual gift. Okay. So it's not that I'm buying X or Y. I'm looking at 3 or 4 different tools and combining them often. I'm saying, well, I have this tool. It really works out well, but I can only achieve 50,000 of the gift with this tool. Okay. Now, that seems to be the lowest cost mining flow through of doing it. That's going to, be an after-tax cost of $2,000 or whatever for that $50,000. That's pretty good. I can do better than that. But then I'm going to look at the next thing and see what's the next step in the situation. So I often combine mining flow throughs with corporate marketable securities. So marketable securities, we know, is a great tool, not product, for planned giving, in that we donate appreciated marketable securities, and the gain is eliminated. You get your receipt, and the gain is eliminated. You get an extra bonus. And we do lots and lots of these. Corporate marketable securities has even one more bonus to it. You donate appreciated securities from your company. You get a receipt. Use that against your taxable income. Okay. Number 2, you're not paying tax on the gain because the gain is eliminated. We're happy then. But in the corporation, and I've talked about this before in our seminars, okay, whenever you have a tax-free item that's happening, that tax-free item the number gets lodged somewhere in the company. So what are we talking about? If one sells a marketable security, not donate, sells a marketable security in a company, 50% of the gain is taxable, and you pay tax on it. The other 50% is not taxable. So we have something called the capital dividend account. And the non-tax gain, well, let's give a number to it. We sold the security for $100,000, $20,000 is the cost. There's an $80,000 gain for book purposes. For tax purposes, $40,000 is taxable and $40,000 is not. $40,000 will go on our tax return, and the receipt of we're selling it. There's no receipt. $40,000 goes on our tax return. The other $40,000 not tax goes into an account. It's not a real account. It's not a money. It's not a bank account. Just a number that says in my capital dividend account is $40,000. The part I didn't pay tax on. What's valuable about that $40,000? When separately, nothing to do with the sale, the company decides to declare a dividend to its shareholder, it can elect to make that dividend out of that $40,000. So I'm making a $40,000 dividend out of the capital dividend account to my shareholder, John. John is Canadian resident. Why? That dividend to John is tax-free, right? Otherwise, high rate, you're paying 40% tax on dividends. No, here it's tax-free. So that capital dividend account is a value. Now, let's go back to our gift. $100,000 security, $20,000 gift. We're going to get a $100,000 receipt to apply against taxable income in the company. There's an $80,000 gain. How much is taxable? Zero. That leaves $80,000 not taxed. That goes into the capital dividend account. That's a big number. So $80,000 can go out as a tax-free dividend. It's very valuable. So, and that, in a sense, when we look at the cost of giving that corporate marketable security, the value of the receipt, the value of not paying the capital gain, the extra value of the capital dividend account, because if you sell it, you half would be capital dividend account. The extra value of the capital dividend account is worth something. And that could mean that your so-called cost of gift could be 20%, $20,000. That's a very low cost of gift. Perhaps not as good as the mining flow through, okay? But still a very valid gift. So I tend to look at what's available mining flow through personally first, okay? And alternative minimum tax is a limiting factor is what I could buy, okay? Next thing, I look at marketable securities, but I try, because I've already used up on my personal tax return these the donation from the mining flow through and in the other factors there, I tend to look in the company and say, well, can I save tax in the holding company? And say, oh, corporate marketable securities, oh, I have room there to use taxable income. Okay, I have taxable income there. Let me make a gift there to reduce taxable income there. At the, for example, on property income in a holding company, 50% tax. Let me say 50% tax on a marketable security gift, and then have a balance there created for a capital dividend account, which is a value. So I sort of try to mix and match. I start with the mining flow through personally and find out what the situation is. Oh, I want to make a $36,000 gift, and yeah, I can buy $50,000. Okay, let's put the extra into donor advised fund. Oh, I want to make a $100,000 gift, and I can buy only $50,000. Okay, let's buy the 50, and then see what else we can do. Go level 2. So I love combining corporate marketable securities with mining flow throughs. Now, there are mining flow throughs which are corporate, right? They're a little more difficult to understand in some ways because the value of them is a little bit more esoteric rather than my tax savings are X, Y, and Z. This is my cost. Here, because of capital dividend account created, that creates a value, okay, which is part of the tax savings of doing it. So it's a little bit harder to see, but it is there. And for some companies, buying a mining flow through, if they have the taxable incomes and everything else like that, especially if we're going to have more AMT issues at personally type of thing, it may mean that corporate mining flow throughs may be advisable again. And because there's no AMT and doing that, and then we may be buying it in the company to a certain extent, and then doing personal marketable securities as the balance if we need it. So corporate MFTs is there, mining flow throughs is there. It's a little more difficult, but as they're going through the planning cycle of combining plan giving tools, I treat that as a separate tool. The corporate mining flow through from a personal one. A personal one, look at the personal situation, spouse, whatever, see what you can do there. Then, okay, next stage, we've outlived that. We've done it to the maximum. Okay, let's look at the company and look at marketable securities, look at corporate mining flow throughs, and see what we can put together there to balance off the gift. So that's the seminar, except sometimes you can use mining flow throughs. I've seen people do it. I did it once, is that making a gift of a charitable gift for someone using a mining flow through. So, I once made a birthday gift to my wife. It's always hard to find the right birthday gift of a social welfare fund. In other words, a fund dealing with human rights and things like that. Now, the fund didn't do anything like that. It went into a donor advised fund, and she had the rights, so she would control it and send the money to, organizations that protect human rights and deal with these kind of things. And that was her gift, to have that lump sum of dollars, and she can go make these gifts. And what a great, I think, a great gift. And so you can use mining flow-throughs, put it in donor advised funds, and tell your children, your others, people in your life, I've set up a fund for you to be able to make gifts. How did you set up the fund? You bought a mining flow-through, and that person that any amount bought $50,000, sends $36,000 to the university, has $14,000, and says, you know what? I have a few more gifts, but I'm going to set up $5,000 funds for this person or that person, for them to go and do philanthropy as a gift to them. And what greater gift is there? What more rewarding a gift is there than to do philanthropy? It's worth more than the ties than most gifts. Physical gifts, which are pleasurable, but to a certain extent, doing philanthropy, I believe, is much more rewarding and pleasurable, and a great thing. So use your mining flow-throughs as a tool to accomplish wonderful things in the world. Thank you.